Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Good day, everyone, and welcome to Property Investing Insights. And as usual, I've timed that incorrectly with the new riff, but feedback's been great with this new riff. You've already probably noticed that his Nibs is not here. Steve's not here, so we get to play. I've got the brand ambassador from Investorfi, Sze Chuah, no stranger to this podcast, but certainly a wealth of knowledge. And coming into Christmas, I did rope in Z to talk about the investor psychology, the psychology around money. And Z, not only from your background, but also from what you do on a day-to-day basis, you're surrounded by the pitfalls of money and the mistakes that people make. And of course, the success, right? Because success does leave clues. And we want to hone down on that. But before we do that, how's things? Have you done your Christmas shopping yet?
Oh, yes. I'm flying out tomorrow. So all Christmas shopping done, all Christmas presents handed out. Mm-hmm. So I, for once, am ahead of the curve in terms of Christmas shopping. But in reality, it's actually my wife that does all of the shopping in the background, and then I take half the credit. So
yeah, well, there you go. There you go. I've been one up this year for myself. I've actually got the Christmas tree out.
Oh, nice.
in time, and not just a couple of days before. Around this time, of course, things become rather frantic with school events, our businesses, and of course, battening the hatches down for the inevitable barrage of requests from property managers. And the biggest thing that I've found over the years being an investor is that we tend to then badge our accountants for the financials because the brokers want the financials, isn't it?
Yes. I mean, like now you've got the perfect opportunity. You've got a new financial year, so new set of financials. As we know, borrowing has gotten a lot harder. So, you know, you've got the opportunity to boost up that income a little bit and get to that next property.
Absolutely. And Z, the reason why we wanted to choose this topic is because you and I have been around for a little while, right? And we've invested through the good times, we've invested through the bad times, we've invested when money was easy to get, and we've certainly invested when money was much, much harder to get. And we've noticed quite a few things that people do wrong along the way, right? And I've actually written down, because I didn't want to, I thought these points were really important, and for the first time I've actually written something down in the phone. Normally I just talk off the top
wrong,
of my head.
Victor?
I know, right? So we'll go through a few points in terms of what people do get right and do get wrong in around money and success.
Yeah.
But tell me, with your investing and with your background in finance, how do you see money?
Money is a vehicle for exchange, right? It's a measure of value. So, you know, the more money that you want to spend on something, the more you value it. And as long as you sort of play to those rules, then like it actually makes a lot of sense.
Yeah, it does.
Like a lot of people kind of fear money, or they feel like they don't have enough, or they want more, or they say, oh, you know, it's a root of evil. But it actually makes a lot of sense in our daily lives.
But we live in a capitalist country, right? So money makes the world go round over here.
Exactly.
And you still have the same problems that you would have health-wise and all that without money and with money.
True.
Except that you've got more ways to address it. Absolutely. If you've got money, right?
Exactly.
And one of the things that we were talking about just before we started was that most people that are starting the investing game or starting to take a strong hard look at money are usually in the later half of their life, in the sense that they're getting close to retirement. Then they're starting to think about, okay, how much do I need to have in my super? How much do I need to actually live in retirement, right? And usually it's something that they tag on a little bit too late, because it seems like the society or the peer pressure is that you can't be focused too much on how much you retain, how much you earn.
Yeah, that's and that's is that connected to our tall poppy syndrome? I don't know.
Yeah,
Like,
quite possibly.
and it's a bit of a destructive thing, isn't it? Like, because if we saw money a different way, like, hey, I can make more money if I help you make more money, and everybody has more money. Isn't that just more constructive all round?
Absolutely. I think people hone down more to the American system of crush them to the ground sort of thing, whereas in Australia and countries similar to Australia, the psyche is a bit different. It's help and be helped rather than smash them down to make a profit.
Yeah, and helping can be a financial thing,
Yep.
like there's nothing wrong with that financial exchange, and again, if you win, I win, and everybody wins.
Yeah. So it all comes down though to education, right? Not
Yes.
necessarily education as in degrees you hold and masters you hold, but how you master the money.
Yes.
Right? And unfortunately, our school system does not teach this. And one of the things that we see as a result is that people then aren't able to make decisions around money, right? And one of the first things I learned in terms of controlling debt is not necessarily the millions of dollars you owe. It's how many dollars per week you need to contribute to control that millions plus that you owe, because that millions plus controls a much bigger asset, right? So the classic gearing effect as such. And that's something that that's something that with a lot of mortgage applications that you have seen as part of your career, it is something that people tend to get wrong.
Well, I would rather owe $5 million worth of debt and have $10 million of assets than owe nothing and only have $1 million of assets, right?
Yeah.
It's ultimately about the net effect that you have, but also the gross, because at the start of your investing career, you need to load up on debt. It's a necessary evil. A lot of people go, I don't want too much debt. I don't want to be in debt. I don't want, what if interest rates rise? What if I lose my job? All valid concerns. So you put in place mitigations for those things, but you still need to load up on debt to start that investment career.
Yeah, absolutely. And it's a cause and effect, right? So one of the common things that we tend to see in both our professional lives is that when people get approved for a loan of, say, 900,000, but then they come around and say, no, I only want to spend 600, or I only want to spend 400. And therefore, the cause and effect of it is that you're really compromising on quality, or you may not be at your full potential for that investment. So therefore, the end result is not that great, right? So one of the mistakes that people do make in the early days, which we've both acknowledged, is that they're either under-leveraging too much in the beginning, so they're putting in too big a deposit, and money gets caught up. Because we're talking about vehicles that are not as liquid, right? So we're talking about property.
Sure.
Or they're over-leveraging, right? So they're getting their 97% loans, 95% loans with in today's climate,
Yes.
with a very high interest rate that they don't have then the ability to then refi out to a cheaper loan. And so realistically, they've locked themselves into that cost.
Yeah, I think we're seeing a lot less of that these days. I think these days it's more of the first thing you said around people going, okay, well, the bank says I can borrow $1 million, but I really only want to spend 500,000 or 600,000. And little do they know that the bank's already being conservative around how much they can borrow, because what the banks do, let's just say the interest rate that they're going to pay is 6%. The banks add another 3% on top of that just in case times get tough. So they're actually measuring you at 9%, not 6%. So they're just being overly cautious just for the sake of being overly cautious. They haven't necessarily done the numbers themselves and said, okay, this is the cash flow that I'd actually be comfortable with. And they're not basing their decision off that. They're basing the decision off what the banks say, and the bank's already being conservative.
Yeah.
And they're basing it on that thought pattern in their head where, too much debt is not good for me. Too much debt is not good for me. So that under leverage effect is is really like widespread now.
Yeah, that's a really a good example. Let's unpack that a little bit more, right? So, when you say that banks are conservative, they also take, of course, all of your commitments into account, right? So they're servicing you at 3% more than what you're borrowing.
Exactly.
And they're taking all of your actual expenses that you've declared.
Absolutely.
And they're also taking all of your income into account, and they're shading the rent down.
Yes, yes.
Right? So that's another
right.
conservative there.
Yes.
So effectively, you can't really go wrong unless you make some really silly decisions along the way,
Yeah.
where you're being over optimistic in having the ability to service the loan. Right.
Yes,
So
yes.
you're not taking into account any life events like, starting a family down to one income, or you changing jobs, getting to self-employment.
Sure.
Yeah.
Sure.
So that's I agree with that. That people do under leverage in the beginning.
Yes. Yes.
As your portfolio increases, I suppose there is a valid case for that, but
Sure.
not in a small portfolio. Right? So when I say big portfolio, I'm talking multiples, tens plus.
Yes, yes. And now that rates are a lot higher than they were a couple of years ago, I think this effect is a lot more prevalent because people are like, oh, interest rates do go up. But little do they know that it's actually likely at the top of its cycle, right?
Yep.
So it's not like they're going to go from 6 to 12%. They're likely to stay around 6, maybe even a little bit higher. But over time, they're starting to likely going to ease after that.
Yeah.
So and once things ease, what happens to the property market? And we've already started to see that already, haven't we?
Yeah, absolutely, we have. So if you look at interest rate cycles, obviously, and this ties right back into psychology, right? Because it's understanding the whole picture as opposed to right here, right now, and having a knee-jerk reaction.
Yes.
So your traditional cycle for high interest rate lasts only 18 months at peak.
Yes.
Right. And then it starts to come down. Now, depending on what the economy is at that time, it comes down rapidly or comes down slowly, but it does come down. It usually comes down over an 18-month period.
Yes.
Then stabilizes. Right?
Yes. And I know we don't like to talk about timing the market, but out of the whole cycle, when is it a good time to buy? Surely not when the prices have already risen as a result of low rates. It's actually when rates are sort of at its peak. People are a little bit less confident as they are now, and there's going to be more growth happening over the next few years.
Yeah, yeah.
Sure.
Because that the effect is that once money becomes easy to get, all these people that are sitting on the sidelines, they will start jumping in.
That's right. That's right.
They'll realize, hang on, my portfolio or my home is now costing me $300-400 less a week because of the lower interest rate. I can actually afford an investment property. So there's more people jumping into the market. Now, we are recording this in the silly season.
Yes.
And one of the other things that does happen is that when it comes to New Year's, you get this New Year's resolution, people that jump in with the investment, just like a gym membership, right? So, and they usually are there and fall off the wagon around February, just like the gym memberships. So I equate that, and I usually breathe a sigh of relief when I'm going to the gym and there's less people there, because I tie directly back to property. Right? If there's more and more people there, that means the New Year's resolution effect hasn't quite finished, and normalcy, in inverted commas, has not returned to the market.
Well, the other thing that's likely to happen is over the next period is that because rents have gone up significantly, and then interest rates are going to stabilize, then people are going to renters are going to start to realize, you know what, it's not actually that much more expensive, if at all, to own my own home. So why don't I just get in? And then once, as you said, interest rates starts dropping and borrowing becomes easier, that effect's going to just blow out. And then what's that going to do to prices?
Yeah, absolutely.
Prices are going to surge ahead again, and then that's going to have more people interested in investing. And I think it's I am, as you know, I've stepped away from finance a little bit more these days, but with my coaching clients, I don't have any reason to tell people. I don't get any incentive to tell people to buy now, but I am telling a lot of my clients, hey, you're in a good position to buy. Why would you wait another 6 to 12 months?
Yep. Because I guess people want social proof, right? I want to see that growth starting to happen. I want to see that interest rate starting to come down. And this is the true psychology. You can't wait for the social proof. You need to look at all the tick boxes. If most of them have been ticked off, you need to jump in. Right?
You're ready. You've got stable income or employment. You're in a stable situation, part of your life, and what's the reason that you would want to delay?
Yeah.
Is it because Jim at the barbecue is saying, rates are probably going to keep going up next year?
Yeah, that's true. I was talking to a client of mine that was having a bit of a moment with these rate rises, and obviously we talked about the psychology with that client, and so this person had started a business 2 years ago, obviously in a bad climate for that type of business because of the higher rates and so forth, right? And left a stable PAYG job into the same industry as self-employed, and bought a home as well at the same time, right? So double whammy.
Yeah.
And then the rates went against them. So effectively, they were about 80K out per year in terms of holding costs, including the home as well. The home mortgage was quite substantial as well. And the income coming in, worst case scenario, was about 80. So there's no room for living in that sense, right? Now we're only taking one person's income into account, so this is the business income. The other partner is working, so there is a bit of a buffer there, right? And what we discussed was, okay, what are our options, right? Now, obviously, the first knee-jerk reaction is sell, right? Sell, and then we are out of it. But does it really give you that leg up, or the hard work, right? Because you've done all the hard lifting now, and you're just before dawn. In that sense, right?
That's right.
Because we know in the market, in the property market, we know as a surety that there'll be some really strong growth imminently, right? Now that imminently bit comes in when finance becomes easier, because every other aspect that we need for good, strong growth surge is there. Migration is there. Shortage of supply is there. High rent is there. And so, and also the knowledge for investing is there. And on top of that, we've had very recent social proof during COVID of some really good growth, right? So once that is fulfilled within the next, say, couple of years, it's going to take off, right? So one of the scenarios we worked on was, okay, what other ways can we approach this? Can we perhaps tap into the equity and take a deliberate approach, a monitored approach to say, okay, I'm going to set aside 18 months worth of holding cost by refinancing one of my loans. The refinance would be actually at a higher rate than what they've got, right? So you sort of think, okay, is that smart, right? But this is done with a lot of advice with the accountants, the financial planners and all that. And the scenario worked out was that we could tap into the equity using limited documentation loans.
Sure.
And the person would be able to get at least 160 out. So 2 years worth of holding cost if business did not improve, if the other person lost their job.
Sure.
And we're monitoring the market very closely to see what the growth is, because we know that for the entire portfolio, including the home, the growth would be more than $80,000 a year. Even on one property, it'd be more than $80,000 a year. Right?
Sure.
Now, so this is where I guess sitting down with someone like you, someone like me, we can look at the what ifs, drawing our knowledge over the multiple years of owning property to see what it really pans out to be. But I just want to caution about the other side of the coin as well. As you know, you don't want to paint yourself into a corner.
No, exactly. But in that situation that you're talking about, yes, it's a higher interest rate, but a lot of the times, you're talking about extracting that equity as a
buffer.
A risk mitigation.
It's more
right?
psychology, right? So it's a sleep at night factor.
Exactly. And they're not using that
No.
cash immediately, so they're not actually paying any interest on it.
Mm-hmm.
So that high rate is actually irrelevant until they start drawing upon it, if they need to draw upon it, right?
Yeah.
So like it just sounds like a very sensible approach if they were able to execute it.
That's right. Yeah. So in your days of being a mortgage broker before, right?
Yes.
People get focused more on the interest rate.
Ah.
What's your approach to that?
Well, they need to look at the big picture. You know, what are you trying to achieve? You know, sure, your interest rate might save you, like a better interest rate might save you $3,000 a year, right? But if that's preventing you from buying another property that could earn you another $30,000 a year, which one would you rather?
Yeah.
Like $3,000 or $30,000,
Yep.
right?
Yep.
Like it was always a question that I had to ask my clients.
Yeah.
And when you put it that way, they're like, okay, yeah, that's right. And any good mortgage broker will ask you at the start of the conversation, what are you trying to achieve? Not just in terms of the immediate, and you know, you might want to refinance and improve your interest rate, but what do you want to achieve in 10, 15 years, 20 years, right? And then tie everything back to that. Because that's really what you want, right? That long-term goal is what you want. The immediate is, you know, I think it's going to help me get to my end goal, because ultimately everybody wants to get to the end goal.
Yep.
And establishing that really brings that question into, like, is the interest rate the number one priority? And then when you go, but you said you wanted to retire comfortably with $100,000 of passive income in 15 years, you're getting a better interest rate, but that's preventing you from getting that next property. So which one would you rather? Grow your wealth and achieve that 100,000, or just have a better interest rate?
Yeah. Now, unfortunately, all the ads and all of the banking ads focus on the rate as opposed to solution lending, right?
Because it's measurable, right? It's measurable, and that's where the value of a good team, you know, your broker, your property advisor, your accountant will sit down with you and talk about these long-term goals. They'll help you, you know, because you'll have a relationship with them, and they'll help you get to that end goal.
Yeah.
But very, very seldom will interest rates be the number one priority to help you get to that long-term goal.
Yeah. There was a podcast that we did do, I think it was like a couple of podcasts ago, where we talked about interest rate being probably the last thing you look at. There's so many other things that you look at. Flexibility of the loan, right?
Yes.
You're looking at how much money they're giving you as opposed to, you know, the rate itself.
Yes.
And then the outcome, the end outcome, like you said, the goal, right? So all of those things need to be looked at first before you look at the interest rate, right?
Absolutely.
Now, unfortunately, we go to a barbecue and someone turns around and says, I've got a 5.9, right? And you die a death because you've got 7.2, right?
I'd rather say, well, I've got $10 million worth of property.
Yes, that's right.
So what about you?
Yeah. and that's a valid question, right? Now, unfortunately, people just get honed down on, like you said, the measurable bit.
Isn't that funny, eh? You can ask people, what interest rate do you have? But you can't ask people, how many properties do you have?
How much equity have you got behind you?
Yeah, exactly. Like all of a sudden that question's, because, you know, most people are sensitive. I don't know that much. You know, But like, interest rates, it's easy to get a good interest rate.
That's right. It seems to be that the thought process there is that if you get a lower interest rate, that means you've driven a hard bargain.
Yeah. You're a good negotiator, right?
Yeah.
So.
Usually, it's more the terms that you're after than the price in itself, right?
Yeah.
Because what price is your money? Is it the price of stunting your growth, or is it the price of cash flow? There needs to be a blend, of course, right? So there needs to be a middle point there.
Yeah.
But you don't want to be focused too much on either side as well. So it comes back to your, over leveraging as well. Now, over leveraging does not only apply to loan to value ratios. It can also apply to what's the takeout finance because you go through finance in cycles, right? You've got a building phase of building up the portfolio. So in other words, buying the properties. Then the portfolio matures. Then you're resetting. Practically every 2-3 years, you're resetting the mortgages if you're not on a strong debt reduction program, as such. And the banks generally don't like you for that.
Yeah, look, I think it's more of an issue of clients getting to a point where they want to continue to grow the portfolio, so they'll look at alternative types of lending, alternative lenders and alternative products.
Yep.
And I think it's important to have a plan in place to be able to get out of those alternative products, because whilst they're a bit higher in interest rate, they will allow you to get to that next property. What you don't want to get into is that prison where you're always stuck with those lenders.
Yes.
You want an exit plan. You want to know that in the next few years your income's going to grow, or your business is going to grow, or you're going to sell a property and then be able to, like you said, reset those terms every 2 to 3 years to ensure that you're competitive and you're on good products that are going to help you, and you have that flexibility to be able to extract equity when you need to, or park your money in an offset account or what have you.
Yeah, absolutely. And I guess this is where a lot of people get the property bug, and they get caught up in the number of properties they can buy, as opposed to taking a methodical approach, both from a manageable position as well as finance in itself. And if they don't take that finance approach, there is trouble in the end.
Yeah. I mean, like, there's no real point in getting spooked to. I'm just gonna put it out there. There are some agencies, you guys are obviously not one of them, that people go to and they go, oh, you buy 10 properties in the next 3 years, right? And what they're referring to is $100,000 properties, because there are still $100,000 properties out there, like in the middle of whoop whoop, right? And then they'll never grow in value.
Yes.
And they may be reasonable in terms of rent, but when there's no exit strategy, when there's no rental growth or even worse, capital growth, there's not much point in saying, I've got 10, $100,000 properties where you could have, 2 or 1 property.
Good growth with good return.
Exactly.
Yeah, and often people like these they do get caught up in a non-liquid market, and they're not able to offload the property when they absolutely need to, and usually that time is when the economy is bad.
Yes. But the thing that will draw them in is that they might buy 1 or 2 properties in this sort of 10 tiny little property strategy, and there are ways to artificially inflate the valuations of these properties. And then all of a sudden they have proof in their eyes that, I bought this property for $85,000. Now it's worth $120,000 because the bank valued it, and bank valuations are always conservative. So it's probably worth, close to $150,000. This strategy is actually working. So it's something that people need to be cautious of.
Yeah, the litmus test there is try selling it in a slow market.
Exactly. Or in any market. Have a look how many properties are on the market currently for that particular suburb, for how many properties there are in that area,
and how long does it take to sell.
Yeah.
Which is when financing becomes harder as well, these are the properties that aren't necessarily favored by the better lenders.
Yes,
as such, right? So you're then forced down the ladder to a less flexible lender. It's not a good retirement plan.
No.
So I guess we need to understand that in the sense of what are we really trying to achieve, and also understanding that given prices are so high. So when you and I started, I bought my first home at $137,000, right? That's back in 1998. And that was mid-priced for that area in that sense. I still got that house right now. If I'm to buy that house now, I'd probably be paying $920 thereabouts, right? On a side note, I've done virtually no work to this property, right? Apart from replacing the floorings and painting some of the walls, which I did myself, and painting the skirtings, which are still half done many years later. But this is where we're getting into properties at that time that were much cheaper. However, when we look back from today, they appear cheap. They were not cheap back then because it came back to how much money you could borrow.
Yes.
And what the average prices were, and the differential in rental, right? So when we did move out of that home, our rent on that initially was 180,000. Then it went to 280. Now,
A week.
yes.
Yeah.
And now it's rented for 720.
Wow.
So over a span of circa 25 years, that's done really well, and that's a true indication of what you can have over a period of time if you held it and had the ability to hold on to it, right?
Yes.
So where people do go wrong is they are checking in to see how much growth they've got every year to begin with. They're refinancing unnecessarily, and it might not be because they want to refinance. It's because they get a call out of the blue saying, "Hey, I can get you 2% cheaper," right? Sometimes it works, right? 2% cheaper. I'd explore that. But they don't look at the overall picture of a refinance situation. So when you're refinancing, what are we looking for in terms of all the ancillary costs?
In terms of costs, yes, you want to minimize your costs. It's just like the interest rate, right? You want to minimize how much you're paying naturally, right? But those considerations, those long-term objectives, what are you trying to achieve? Are you wanting to buy more property? Are you able to buy more property? Should you be buying more property? That should be the primary consideration, because we're all talking about a wealth growth. Growing a wealth, that's what we're talking about here. So, like, you're not going to be growing your wealth by just buying one investment property and spending the next 30 years paying it down, right? Like, you could, but it's a really, really slow process. And, at the end of it, the rent that you get is, pretty... It's not going to cover your retirement.
Yeah, so it'll give you on a half decent property, say 500 to say, let's call it $1,000 a week.
Yeah,
right.
Sure.
That's $50,000 a year.
Yeah, but after all the costs associated, you're not going to be able to retire on that. So this is why I keep on banging on about the long-term objectives. What do you want to do? What is it that you're trying to achieve by holding investment property? And a lot of the time, it's either the passive income, or it's either net wealth, or a combination. It's pretty much the same thing, right? You're wanting to achieve a net amount of assets that's giving you an income that's going to allow you to retire comfortably, have more choice, more freedom in your life, right?
Yeah.
So how does your refinance, because every decision that you make needs to tie back to that long-term goal. And again, this is where the value of your team comes in, because they're the ones who are going to be able to give you that answer around how does your next decision tie into your longer-term goal. What's my borrowing capacity? Okay, what if I were to refinance with this lender? How much equity am I able to take out? Does this mean that I'm essentially trapped with this particular lender or other particular lenders? What are the implications of that? Right. So that's where those are the things that you need to explore in order to determine whether it's a good refinance option.
Absolutely. And so the flow-on question from that, Z, is there such a thing as bank loyalty?
Bank loyalty? Well, it's actually the reverse, because there's a loyalty tax, right?
Yes.
So many people, and that's a great point, Vic, because many people, as you're aware, they have that misconception where I've banked with CBA for 20 years, they're looking after me, don't worry about it. And well, little do they know that the interest rate that they're on is likely a lot higher than what a new customer gets. So when I tell clients that, and they realize that, they're like up in arms, because that's where the loyalty tax is. Because if you take out a loan at say 6.5%, let's say, what the banks have is what they call a standard variable rate.
Yes.
And it's not something that anybody really pays, but it's just a benchmark, right? So let's just say the standard variable rate is 9%, okay? So the bank's saying, because you're a good customer, I'm giving you a 2.5% discount, okay?
The word discount, right?
Yeah, that's right. So you feel good, you feel like a VIP, you go, I'm getting looked after, right? But the next year, little do they know that every year the discounts increase. So when I started out as a mortgage broker, discounts were like 0.3%. Now discounts are over 2%.
Yeah.
So every year it actually increases. So next year, the discount might be 2.7%. But you're still on a discount of 2.5%. That means you're on a higher rate than the new customers, right? Yeah. And then that gets worse the following year, and then the following year, and then the following year. And then all of a sudden, if you're loyal to your bank, all of a sudden you're way behind the 8 ball. And it's no fault of a lot of people, because we all run busy lives.
Yep.
Who has the time to keep on shopping around every 3 months for a good interest rate? Do they have time to keep calling up the bank going, is it the best interest rate? And what's the bank going to say? Yeah.
You're the best we can give you.
Yeah, exactly. Best we can give you, right? So that's why loyalty absolutely doesn't pay. In fact, it's the reverse, because A, there's a loyalty tax, and B, when you're looking to refinance externally, there are a whole heap of banks that are there waiting, chomping at the bit to get your business, because they go, oh, you know what, we might pay you, $3,000 to come over to us. And or they'll give you an even better interest rate than what your current bank can offer, because they're incentivized to win your business.
Yeah.
Because a lot of people are like what you just said. They hit and stick. They go, it's a lot of hassle, filling out an application form and
getting all the paperwork.
Getting the paperwork, and then, putting in this application, I have to talk to my broker. And
especially if you've got a big portfolio as well.
Oh, yeah. And yes, absolutely it is. It is a hassle, but it is a lot of the times worth your time to even just explore it.
Yep.
Because even by asking the question and knowing what else is out there, you can go to your bank armed with that information and say, "Hey, I want a better discount, CBA, because Westpac's going to offer me this." And then some of the times they'll go, "Okay, fine, we'll do the same as Westpac."
Yeah.
Just to prevent you from going over.
Because you're more profitable retained than losing, right? So it's much more costly to bring in a new client than to retain an existing one. And I'm testimony to that. One of my loans, I realized, went to variable at 8.6. Right?
Maybe it was SMSF?
No, it was not. It was a standard deposit taking institute.
That's how they make their money, right?
That's right. And because I'm busy, but I'm still got my finger on the pulse, I was able to catch that early. And I basically picked up the phone, talked to the relationship manager and said, 8.6, I can get 6.5, because I did my research beforehand, right?
Yes.
And the end result was that I got 6.86 from an 8.6, right? That's a huge discount. Now, if I hadn't paid attention, do you think the bank would have come to me and said, you're paying 2% more than what you should do?
I can't ever remember the last time the bank called me to say that.
Yeah. So you heard it right over here, guys. Z is saying cheat on your bank.
Absolutely. Shop around.
That's it. Now, one of the things that as you're building your portfolio, people tend to forget that even with all loans paid out, there is still expenses within the portfolio, right? So this is the psychology that people miss out on, in the sense that there's always running cost to everything. Of course. And in my portfolio, my running cost is 20% at best, 26% in a bad year, right? If you've got a few more repairs and all that sort of stuff. Now, and that's because I run a consistent maintenance program on my portfolio. But this is where people do get caught out when they're not planning for this expenditure. And let's say you pulled out a figure of $100,000 in retirement. So if you're aiming for 100, your gross income should be 120 from the properties, right? Because you got to give yourself that buffer.
Exactly.
So if you're tapped out in terms of being able to borrow money personally or through your trust, are there other avenues that you can look at with accountant's advice?
Yeah, good question. And I think you sort of you touched on it a bit earlier with lower documentation type loans, and that's typically available for self-employed people, so those people who run a business or they're a sole trader. So there's still avenues available for those types of people to go to their broker and say, hey, are there any alternatives to me showing 2 years of tax returns and financials? Can I get my accountant to vouch for me? Can I just show my BAS account, my BAS statements, or can I even show my business bank account statements?
Yep.
They show a lot of credits, right? And in some cases, the non-banks will allow these types of loans and this type of income verification because as many people know, and I'll put this on record, a lot of self-employed people don't want to show every last dollar that they earn.
Or you don't say.
No, I know. It's it's never been said, but or they're inflating their expenses. So nobody wants to pay tax that they don't need to pay, right? So some lenders recognize this and they go, look, we know what being self-employed is like.
So in other words, they've got really good accountants.
They've got good accountants. But what we're finding though these days is accountants are being incredibly more conservative than they used to be in yesteryear. So accountants, in fact, accounting bodies like CPA called you out, and they're saying don't sign accountants' declarations for your clients, right? So that sort of puts a lot of our clients in a bit of a spot of bother.
Yeah.
So there are some ways to get around that, even because if your accountant's saying, I don't want to sign a declaration for you about your income, then find another accountant. just kidding. Although only partially, because you want to make sure obviously your accountant is aligned to your goals and your strategies and so forth. But what you can do is find a lender that allows your accountant to not say, Victor and his company is earning $500,000 a year, but I understand that Victor's looking to take out this new loan and the repayments are $6,000 a month. And I understand, in my professional opinion, that that Victor should be able to comfortably meet the repayments. Yeah. So that way your accountant's not being put in a difficult situation where, they may or may not have lodged something, right?
Yeah.
And then they're forced to declare something else.
Yep.
Yes, many accountants are not going to be comfortable with that. This way, accountants are like, oh, okay, well, yeah, I know Victor, he earns good coin, and I don't think he's going to have a problem. He's never had issues. I've known him for a long time in repayments. Yeah, that's fine. Here you go. Yeah. So that's a way to get around it. Another couple of ways is just, as I said, relying on BAS statements. So your GST activity statements and or your business bank statements. So there are other forms.
Yep.
Instead of just relying on your accountant's declaration on your income or profit.
Yes, and that's really important, because a lot of times people, when they get their first knockback, they stop exploring, right? You usually get a knockback. Well, sometimes you just simply can't borrow, right?
Sure.
We've got to acknowledge that, right?
Sure.
And it is silly to borrow
Sure.
if that's the case, right?
Yeah.
But sometimes being knocked back means that you haven't asked the right questions.
Yes.
Yeah.
That's right.
And it's really important from a money psychology point of view to arm yourself with asking the right questions, or surround yourselves with people that are asking the right questions. In other words, a broker that's cluey, an accountant that understands these low doc declarations.
Yes.
As such, because most accountants that are not investor savvy are also too tax minimization
centric, right?
Yeah. So one of the things that I think biggest thing from a investor psychology, from a money point of view, the success that money brings is understanding that you can't have a tax minimization and a wealth accumulation scheme together.
Yeah.
They run they're two divergent strategies that don't run parallel to each other.
And you know, from a, like, if you took a step back and looked at it, it kind of makes sense, right? Like, if you're making money, you've got to pay a bit
tax.
of tax.
Yeah.
Right?
Legally, as much as you're legally obliged to. Don't overpay.
Exactly. I agree with that. But you've also, you know, this wonderful society of ours has presented you these opportunities that you've capitalized on. So yes, you need to pay a little bit, give a little bit back. Right?
Absolutely. I guess in one of the things as investors do get a lot more runs on board, one of the psychology that tends to play havoc with their buying strategy and their rapidity of what they're buying is that still compared with prices they paid 2 years, 3 years, 10 years ago, right? You and I both have that issue, right?
$130,000 property
Yes.
in Campbelltown. It doesn't exist, right? No, I agree. You know, like it's a hard thing to get over, isn't it? You go, I could have bought that for $500,000. Why is it like? Why are you telling me this is a bargain for $650,000?
Yep.
This would be your daily conversation, I'm imagining.
Absolutely. Yeah.
It's just,
Setting the benchmarks and then also comparing it with what a friend paid. It could be a different property in the same suburb, but the property's got a different strategy and different finance capabilities. He may have the other friend may have a different financing capability.
could be like power lines next to it, or you know, backing onto a reserve with a, you know, high fire danger, flood zones.
Yes.
There's the list is very long.
Yeah, or it's got doctored photos on the internet, right?
Oh yeah.
So I guess with us rolling into the silly season, it'll be negligent of us not to say that you should not be buying where you're holidaying, right? Don't get caught up in the emotion. That's one of the biggest things that I find that with investors that do go wrong is that they're putting too much emotion into play and they're buying with emotion rather than figures.
Yeah, it's tempting, isn't it?
It
Though?
is.
Like, because you're away, you know, you're having
relaxed.
relaxed, having the best time of your life, surrounded by loved ones, and you know, you're in that buying spirit. Like, it just seems like a good idea.
Yep.
And you know, your mind's coming up with all these great ideas and why, you know, like surely everybody would love this place that I'm in right now, right? And surely it's got growth. And sure enough, if you go to talk to the local agents, what are they going to say?
Yep.
Of course, it's a great investment. So how do you counter that, Vic?
Well, you know the old adage of, you know, you freeze your credit cards, right? There was a very early in the piece, right? When I was starting my money education, right? And this is the reason why I'm so successful with property investing is I actually I learned about money first, right? So as a bit of a background, as you know, I come from Fiji, right? So I come from a farming community, and to have debt was a big stigma, right? I still remember my parents going to the Bank of New Zealand, BNZ, right, which is a derivative of ANZ, and that was the only air-conditioned building in the town, right? And they'd wait downstairs. The loans department was upstairs, right? They'll wait downstairs when they're sure that there is no one there that they know that's in their circle of friends. Then they'll scoot upstairs to get money advance for the crop, right? So in other words, taking out a loan. So that's the stigma, and that's the paradigm that I grew up with. That you know, debt is not good, right? It compromises lifestyle, but you need it. You know, you are needy if you're borrowing money, right? And to shift from that paradigm to understanding debt and being able to control that, I educated myself. I read books, I went to seminars, I did courses, and that then flowed on to property success, right? And so when people that are starting, we've got a good time now over this break, to start thinking about these sort of things.
I had a similar experience, right? Like after I bought my second property, I remember my mum panicking.
I remember that.
Yeah, she was like, "Stop buying, stop! No, you're gonna lose it all." And she never had, "Mum, I love you, but you weren't right about this, right? Like, stop buying, like, and if I had taken her advice, then I would have never built the portfolio that I did, and many people are in that similar situation. Like a lot of us with ethnic backgrounds, or just old school parents. Really, they're just dead averse. Oh no, don't owe too much. If you owe $1 million, your life's over. Whatever it is, right? So if we listen to that, and they all have good intentions for us, right? They're saying this out of care, love and care for us. They don't want to see us go down, but like that's in their world, right? That was 50 years ago, or in a different country.
Yep.
Right. So that the rules are different.
Yep.
Today.
The rules are different. The experience is different, right? So when you're taking advice, you need to look at two things: qualification, right? And that's just not the paper that's hanging on the wall, but it's also their life qualifications, right? Have they actually achieved what they're advising you on, right? And in the case of our parents, right? So they came from a different consumer psychology. And therefore, they went through the depression, the Great Depression. They also came from different countries in our case.
Yeah.
And so the outlook towards that is very different. Whereas now it's more entrepreneurial. You're looking at it more from a commercial aspect, and we're looking at it as money as more as a tool rather than something that's evil. In that sense, right? And owing money, it seems to be a badge of honor. In this country, so you just need to.
It that way.
We just need to make sure that you're owing money for the right reasons, as opposed to just owing money for the sake of owing money, so that you've got the barbecue brag rights, right? So as we conclude, Z, what's your takeaway for our listeners today?
I think we haven't touched on it, but if you are thinking of buying, just look to buy imminently. We haven't touched on that. Often around this time when we're doing these podcasts, we say what a wonderful time Christmas can be to look to purchase. There are bargains around, but more importantly, we're at a point in the market where I personally believe that there's a lot of growth over the next few years. So the fundamentals, like we said, the fundamentals in place, the shortfall of supply, the surging demand for a number of reasons, the stabilization of the cost of money. So these things are going to really contribute to a surge. So if you're thinking about it over the next few years, I would really consider I'd urge you to consider bringing that forward and using this holiday period to educate yourself, surround yourself with the right people and get the right advice, and start taking action sooner than you normally would if you let another Christmas go by and then you go, oh, okay, well, yeah,
I've missed the boat
busy. Yeah. And then you wait till the next cycle. So
no, absolutely. That's really sound advice. And my takeaway for people is that adding on to that is obviously know your baseline, know where you're starting from, and know where you're heading. And that way, you can then simply put all the pieces in place to get you there. And I agree, now's the best time to get started. Now's the second best time to get started. The best time to get started was 10 years ago, and we go forward 10 years. We'll be saying the exact same thing, right? The best time to get started was 10 years ago.
Yeah, exactly.
So that's Property Investing Insights. I hope we've put good value. And wherever you're listening, please share this on whichever platform you are. Give us a star rating or share this in your socials so that we can spread the good word. And if you needed to speak to me or Z or Steve, send us an email, questions@rightpropertygroup.com.au, or reach out on our socials.
Well, thanks for having me.
Been a pleasure.
See you next time.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.